Good afternoon, everyone. A big welcome. Thanks for coming. Today we will talk about divergence analysis. Divergence, in fact, is a quite popular setup in technical analysis, and in my opinion, one of the most beautiful situations in technical analysis. But probably because it is so popular, so often mentioned, there are little things on trading divergences that we often ignore. We take for granted that we know everything about divergence analysis, and basically we trade knowing that a divergence situation is basically a higher highs on price and unconfirmed by oscillator, and not much more than that. And in fact, divergence analysis requires a deeper understanding in what momentum is. It requires an understanding on a conceptual level as well of what is a divergence, and more importantly, what is not a divergence, what is not possible to do with divergence, and the meaning and the origin of it. So that's basically where we are going to start. With distinguishing these two basic concepts of confirmation and divergence. Confirmation is one of the basic concepts in technical analysis. If you have some notion of those theory and its basic tenets, the confirmation is the most basic principle of those theory, and basically it says the confirmation is when prices go up and indicators signal internal strength. So confirmation is also when prices go down and indicators show internal weakness. Confirmation is therefore a convergence between price and the indicator. That will be a confirmation. If we want to be more precise in terms of the theory, confirmation was initially the consideration of the industrial and railroad averages together. It comes when both the industrial and railroad averages reach new highs or new lows together on a daily closing basis. Okay. Today, two of the three major averages, the industrials, transportation, and utilities, must confirm that the same direction to be used to have a confirmation. Okay. This is important to distinguish the term of divergence. So divergence is any combination of conflicting directions between the slope of price and the slope of momentum. Okay. It's when indicators fail to confirm price action. So we have a divergence. So the divergence somehow is born out of the concept of confirmation. Okay. That would be the origin of the concept. So divergences between price and indicators are not a confirmation signal. Okay, they signify a lack of confirmation. Okay, this is important. This on a conceptual level, it's important to understand the divergence as a lack of confirmation, not so much as a signal in itself. Okay, this will prevent us from many errors when we become more practical. Okay, so we can also say that confirmation and divergence are opposite concepts in technical analysis. Okay, the definition of divergence, the most common definitions that we use to define divergence is, on one side we have negative divergence, a situation when the price hits new highs and the indicator or the indicators show minor highs. So it's a bearish alert. And a positive divergence, a situation when the price reaches new lows and the indicator prints higher lows. So unconfirming the price action. So it's, in that case, a positive divergence is also a bullish alert. It's important also when we consider confirmation and divergence that one of the basic principles of technical analysis is the assumption that a trend is in place or still operative until we have enough evidence that the reversal pattern has been formed and completed. Okay, we always expect a trend to continue. This is one of the basic tenets in technical analysis, and although very basic in itself, very simply, it's sometimes forgotten when we feel the impetus to fade a trend, to enter against the trend. It's useful to think that one of the basic principles in technical analysis, the existence of technical analysis in itself, is because prices trend, and they used to trend beyond the extremes that we might think are the objective target for that trend. Okay, so until we don't have enough evidence that we have a reversal in place, so the trend is still considered to be operative. The analyst should therefore also be careful when using price indicators as confirmation, maybe more redundant than informative. Okay, so we'll see some examples in how to prevent that. Okay. So jumping from the definition to some guidelines to become a little bit more practical. I'm asked to raise my speaker's volume. I wonder if I can do it, but I can speak a bit louder, Mike. Okay, I'll try to speak a bit louder. Okay, on the guidelines about divergence. Divergence are mostly spotted with momentum indicators. Okay, also called oscillators. Okay, here we have a few of them: MACD, RSI, rate of change, momentum, stochastic, Williams percentage R, CCI, trend deviation, etc. Okay. Maybe at this time we should see for a second what is momentum, to define some characteristics of momentum that will help us in spotting divergences, in understanding divergence a little bit deeper. The level of momentum informs about the direction and the quality of the trend. Okay. So in some cases we can use momentum and momentum indicators as a mean to have the direction, the trend direction defined. Okay. It's not only that we use momentum or oscillators in ranging markets. That would be the most common rule than when we hear about these kind of indicators, but the nature of momentum calculation also allows to spot direction. Okay, and obviously it allows also to verify the quality of the trend, and by quality we mean speed, we mean strength, and a few more characteristics that we shall see in a minute. Thus, a falling momentum does not imply falling prices. Okay, I think this is a basic idea, but should be mentioned, because what a momentum indicator does, it detrends price action, and it lets the price action oscillate above and below an equilibrium line, so to say. So by detrending the price action, it means that falling momentum does not imply falling prices. Okay, it's only really falling momentum with all that momentum means. So momentum indicators are very sensitive to changes in acceleration and velocity in the price. And acceleration and velocity are two of these characteristics that make momentum indicators so special. Here we have, for instance, an illustration with a car accelerating from 30 km to 60 km. So we have an acceleration and also an increase in velocity, but we may have a constant velocity if the car, for instance, goes up to 60 km and sustains that velocity. We can still have an increase in price, and we can still sustain that direction. The car can still drive in the same direction, but there is no more acceleration, and the velocity has become a constant. The speed, in fact, in technical analysis, the speed is so to say the distance covered over time. Okay, it's a difference of we shall see in a moment examples of that, but it's the distance covered over time. Speed is also a more sensitive measurement than price level. Okay, you receive an earlier alert of a change in speed before you realize a change in a sustained change in the price level. And acceleration, in turn, is more sensitive than speed. Okay, I have to accelerate first. The car has to accelerate first before it changes the speed. So the speed is also the measure of the price trend's changing slope, so to say. Okay, for example, if a 5-day change in price is an increase of 100 pips, then momentum is simply 100, but the speed is 100 divided by 5, so 20 would be the speed. Okay, if prices continue higher at the same rate, the momentum, the speed, turns sideways, becomes a constant. Okay. And because of this sensitivity, of this high sensitivity, momentum indicators alert of a change in trend much before it happens in the price structure. Momentum, it's also important to understand that the mean, generally speaking, when we speak about the mean is the best forecast of future prices. And the zero momentum value represents that mean. We have here below, for instance, we see here compressed MACD, and the mean would be the zero line in that case, where the oscillator oscillates above and below. Okay, so the zero momentum value represents in that case the mean, and the mean is one of the best forecasts of future prices because it periodically always returns to an historical mean. This is a concept that can be further explained and can be quite complex, but it will help us. The notion of what a mean is and that the mean is reflected in oscillators can help us in when becoming more practical with trading with oscillators. Okay. Also important when talking about momentum is that momentum values that are not extreme give us very little information. Here, for instance, we have a divergence situation in this chart. We see above price structure and below the oscillator, and we see that these levels, they come from this previous image. We see that the divergence here, notice on the MACD window, they are found in the upper range of the historical highs in that indicator. Okay, so when spotting divergences or using momentum indicators generally it's important to understand that these indicators are made to spot for extreme values. Okay, and sometimes those extreme values, like here in the MACD, are historical highs and lows in the indicator, because the indicator is not bound to a finite bound. But in cases where we have an oscillator like RSI or stochastic, where the limits are where the oscillator is confined to a limited band, then you don't need to review the historical extremes, so to say. Okay, only in case of an open indicator like the MACD. So when finding divergences using MACD, it's useful to verify if that divergence is occurring on an extreme situation. Okay. Fine. So if we go back to the guidelines on divergence trading, divergence is important to understand that it is considered a warning, not a signal in itself. Okay, we can derive signals from it, but in itself, the situation is a warning, is not a signal. Remember that this is the opposite concept of a confirmation. So it's the lack of confirmation. But in itself, it's not saying you should commit to buy or to a sell position, but rather informing about a weakening price structure. Okay. Rocky is asking what time frames provide more powerful divergence signal for a trade. The divergence is a situation that occurs in any time frame. In any time frame, it's more important than the time frame in itself is how you find the right parameters in the oscillator. Okay, and we shall see some examples of how to find the best parameters. Okay, you can also combine the different oscillators with different parameters, longer and short term. But in fact, it's not the time frame in itself which will offer good divergences, but the parameters. Obviously, from market to market, it changes. So you may find that a certain market has a tendency to print divergences on a specific time frame or time of the day or time of the week, or a certain pattern which is occurring based on a divergence. But generally speaking, it's not so much the time frame, since it may happen in any time frame, because it's really momentum. We're speaking of momentum, which is in fact is speed, and price is constantly accelerating and decelerating. So, and this happens on all time frames. Mike also says it's maybe your only lead indicator out there. Exactly, it has some characteristics of a leading indicator, especially when we are able to spot these two characteristics of acceleration and speed. In those terms, it's used as it's considered a leading indicator. That's right. It's also by detrending the price, it becomes also much more sensitive. If you have an oscillator and a moving average, whatever, simple or exponential, even an exponential, you will see that both indicators on the same time period, so to say, calibrated for the same time period, the oscillator will be much more sensitive to what price is doing, because it detrends the price and shows the oscillating action above and below the equilibrium level, so to say. Rocky says in multiple time frames, 1 hour, 4 hours, 30, 50 minutes, it varies. So what has to be done in that scene. If you spot for a divergence in a certain time frame, so it means that the management of that position derived from that indication should be done in that particular time frame. The bigger the time frame, it's also the larger the duration of the setup. The building of the divergence, the forming of the divergence, and also the development, the further development of the eventual change in trend. So if that is situation is spotted in one a specific time frame, you should also follow up the situation in that same time frame. Okay. If you have conflicting signals in one and another, then it becomes more complex. But you can maneuver it to find probably a better entry on a lower time frame than the one you spotted the divergence. But here we are becoming already very specific on the trading strategy. Okay, this is perhaps a bit out of scope in this webinar where we speak of general terms. I will not enter into a specific strategy. Okay. There's one more question. Do we have a way to determine how many pips the price is going to move in cases of divergence? No, divergence is not telling you the magnitude of the ensuing movement. So that is not an information that you can gather from a momentum divergence. Okay, because what you are identifying with a divergence is a weakening price structure. Means that the prices have gone higher with less strength. So and it's decelerating. Price is decelerating. So you have an alert situation and a warning about a unsustainable trend, a trend that might be on the verge to change the quality. And change the quality of the trend means it may change from up to sideways, or from up to down, or from down to sideways, or from down to upward. Okay, a change in the trend and the quality of the trend doesn't mean necessarily it's going to change the direction. Okay, when we speak of quality, it means there may be a change simply from a directional movement into a sideways movement. Okay, but the objective, the target of a divergence is not given in pips. Now we will see some. I will give you some hints on how to measure targets with oscillators. We'll come to that point in a minute. And a few more points, a few more guidelines on trading divergences. With a less pronounced divergence, the probability of a change in direction is low. Okay, this is similar to the point we've seen on momentum indicators, that we need extreme levels. So if you have identified a divergence, for instance, like we see here in this chart, where the levels are not extreme, the price action is also not showing an extended movement in one direction, then you better be cautious with this kind of situations. Okay, so we need well-pronounced divergences to have an assurance that the probability of a change in direction is high. Okay, like it happened here on this chart, and we see that the momentum indicator was in fact able to register much lower values in, like we see here. So those extremes here in the oscillator are really not extremes or historical extremes for that particular instrument or for that particular time frame. Okay, so always look for the history of the indicator, what it has been doing. And the more complex the divergence, the more deteriorated the price structure. Okay, so we can have a lower momentum peak falling between two peaks. Okay, in that case, two valleys. Okay, like we have in this instance. Okay. We had a first divergence here, which didn't play out totally, and then the indicator in that case printed another value and printed a complex divergence. And in that case, it is considered from a technical perspective that the price structure is really more deteriorated. Okay, so often we give up trading the first divergence only to see that then we have, after eventually being stopped out, we see that price going into the direction warned by the divergence setup. Okay, so there are ways to avoid this, as we shall mention in a second. Also important to mention that not all trends end with a divergence. Okay, it's not a requirement that every time there is a change in price, there should be a divergence. Obviously, you can bend the indicator to have a divergence, but this is only in hindsight. Usually, it's important to understand that not all peaks and values and valleys will form a divergence. Okay, we have here both cases here where the oscillator was printing high highs, confirming in fact what price was doing, and yet we had a reversal. Okay, so this gives also an idea of what we could do in those cases, and we shall see here. For a better understanding, this is the complete tree on divergence analysis, where we have the classic divergences, the ones that are most often mentioned, that we have been introducing here, but we have also hidden divergences. Okay, we'll speak in a moment about it. And belonging to the same family, there are also swing failures. This is a less mentioned, less known setup using oscillators, but which belongs to the same family, and which is extremely interesting as a trade setup and trade signal. Let me see if we have a more question here. Rocky asks, is major time frame divergence more trustworthy? Not necessarily. It's just that the magnitude will be greater. Okay. Again, as I mentioned before, it may depend from instrument to instrument. Okay. In technical analysis, there is nothing that says that divergences in higher time frames are more trustworthy. I haven't found in years any such principle. Okay, but when talking about a specific instrument or specific market, then you may come to this conclusion, obviously. Okay, but this is the result of a deeper testing of this kind of setup in a particular instrument. Okay, but it's not that there is no general rule that says that. It's just the magnitude of the ancient movement that is greater. That is obviously because the momentum which is showing an extreme is also denoting that price has also reached an extreme and is about to turn in towards the historical mean. Because remember, the mean is the best forecast. Prices always return to the mean. Okay, when considering a distribution of prices. Okay, they always return to an historical mean. So that return to the historical mean will probably and obviously be of greater magnitude in a major time frame, much much more in terms of pips. It will be larger in a daily time frame than in a 50-minute time frame. Okay, because the historical mean will be further away. Okay, in terms of points, in terms of pips. Okay, pip runner. What has been happening is likely to stop. What has been happening is likely to stop happening. I don't know if I fully understand that statement, but it makes sense. Coco says in retracement mode, we are often told to switch to a timer, to a smaller time frame to spot the end of the retracement. But sometimes the size of the small time may trick us into believing the strength or weakness of the signal. Yes, here we are entering on specifics, on strategic considerations, which are subject to testing. Okay, but yes, you can fine-tune your entries, obviously, if you go lower on a lower time frame. Remember, and the divergence situation is a warning, an alarm. Okay, it's not a signal. So you may use a divergence situation on a higher time frame, let's say a 4-hour time frame, and use that situation as your first a signal, so to say, to start preparing for a position on a 4 times or 5 times lower time frame. But you are not using the situation, the divergence situation alone, but you are now searching for a consensus of other indicators on a lower time frame. Okay, and this is always a must when trading divergence. You need consensus from other indicators, because in itself the divergence is not a signal. So you may, like Coco says, to dive into a lower time frame in order to find a more precise entry and exit level, and this can be done simply by a breaking of a trend line, a crossover of moving averages, a combination of both, or simply using horizontal support and resistance, etc., etc. Okay, but always searching for that consensus. What momentum oscillator do you prefer when spotting divergence? Personally, I have more experience trading with the MACD than with others, but you can use as well RSI, rate of change, momentum. These two, rate of change, momentum, depending on the platform you're using, it's called one way and the other, but are usually very fine to trade divergence. I prefer less nervous momentum indicators like MACD, for instance, than RSI or stochastic. Okay, but all they are can be used. Okay. Can we talk about hidden divergence? Yes, Tom, we will. Do you have any live chart to show? We can understand better. You're explaining very nicely. We will see some charts. I do not have live chart in this platform here, but we'll see some examples here, which I hope will be of your interest. Let's just review briefly the classic divergence. This is what we have been seeing here. The classic bearish or a negative divergence is when price prints ascending peaks while oscillators shows descending peaks, like we have here on the left side, for instance. We have here price printing a higher high and an oscillator, in that case the MACD, printing a lower low, okay, above the median, above the zero line in that case. Okay, in that case we have a bearish or a negative divergence. And here we have that same divergence, and this may illustrate some of the questions we had on how to combine different time frames. This is a daily time frame, while this is a hourly time frame, or hourly or 4 hour, I can't remember. But in any time, in any case, it's a lower time frame. And here we see that that same divergence on the left is here marked with this yellow dashed line. Okay, this is the setup, and this is also a way that we might filter our divergences by going to higher time frames and verify if that situation is evolving in a specific or a significant resistance or support level. Okay, in case of a bearish divergence, I want to spot for reversal levels, and we see here we had here a high with a recent high, but previous price action has been picking the supply from this level. So in that case, we are breaching these prior highs and entering into that zone here, which still allocates sufficient supply. So on the bigger time frame, we are seeing that divergence setup, which is occurring on a lower time frame, is occurring on a macro scale, is occurring on a very convenient level. Okay. This is the classic bearish divergence. Then we have the classic bullish or also positive divergence. The price reaches lower lows while the oscillator shows higher lows. It's the opposite of the previous one. Okay, relatively easy to spot. The only thing is that we verify each time if that there is really a divergence. For instance, we have here a higher low in the oscillator, but which is not confirmed by price. So we have to wait into this further deep into lower levels, but already with less strength. And here we have the divergence analysis. Sometimes the crossover itself of the MACD is used as a signal, okay, but here already the signal is not derived from the divergence itself, but from the indicator. Okay, so it's important to mention this again. So and important also when trading divergence is that there are many things that can go wrong. We know from experience that things might go wrong when trading divergence. Although a very popular setup, it is rather difficult. It is rather difficult to trade. Okay, one of the things we might encounter is that prices tend to extend much further than a minimum objective target. Okay, they might go much further than we might think that they should, or any target that you had on the chart. Okay, and this is the very nature of financial markets, especially of leveraged markets. Okay, like futures and spot forex. The price may extend further than what was thought as an objective target. Against this, we can always combine, or should always combine, support and resistance analysis or a consensus among several indicators. Okay, like we have seen in this previous example where we identify the resistance levels, but we may use also a consensus among several indicators to confirm that situation. Okay. Also, large distances between the extremes used to draw that divergence. They are very far apart from each other. Okay, it may not work. Divergence analysis starts again once a major rise or decline has occurred. There is no relationship to the peak or to the bottom of the previous major cycle. Okay, so be careful with that. Do not try to force your chart into a divergence where what we have is in fact two different market cycles. And market cycle, this term, I'm with a purpose I mention here a cycle because momentum indicators are very much used to spot for natural cycles in markets, and you don't need to be very complex into cycle become very complex into cycle analysis. It's just the basic idea that a momentum indicator, what it's doing is detrending the price structure and showing this cyclic movements above and below an equilibrium level, and we call that cycles. So it's useful when measuring what is the parameter to be used with any indicator, that the parameters used are not much bigger than the price cycles that we are seeing on the price structure itself. Okay, so always find that parameter for the momentum indicator that is not too far from the movements the price is doing in that particular time frame or for that particular instrument. And this is something that is done by eye simply. You just zoom in and out in the chart, and you detect this oscillating action in the price, and you try to find the parameter, as we shall see an example in a minute of the best parameter to capture that cyclic movement. And then to come back to the point, avoid making divergences between peaks of different trends, of different cycles. Okay. Another peril when trading divergence is the fact that they are often recognized too late. If the current value of momentum is lower than the value of momentum of the previous peak, an anticipated divergence alert exists. So I may detect a divergence before it exists already. Okay. So if I see that, for instance, we had this situation here, I see that prices are starting to rise very, very fast on this candle here. So much before we have the entering or the movement or even the trigger, the signal from the MACD in that case, I already see that prices are ascending to a new high, but it's very improbable that the oscillator will print a higher high. So already while the price is ascending and entering into new high territory, I already see in the action of the momentum indicator that it will not print a higher high. Okay, it's something very, very, very abnormal should happen for this indicator to print a higher high, because that means I would need a price that is accelerating even more, and it's already accelerating a lot here. So while the price is entering that new high, if that new high from my consensus of indicators shows a level, in that case, where a sell commitment can be done, where I can enter a short sale, then why not anticipating that divergence situation, which will probably, with a high probability, occur. Okay, and this is what I'm referring to when I say that I can anticipate a divergence analysis, divergence situation, and for this situation, it's also important to keep in mind that the peaks in the momentum shall be extreme. That is, the first peak in the momentum shall be extreme. Okay, we cannot anticipate a divergence if we are using very low momentum values. This is very dangerous because price can still accelerate a lot more. Okay, so if the first peak is already an extreme value, why not anticipating the situation and not waiting until it is too late to recognize it. Also, the timing on profit taking. There was a question before. There is a question before on profit taking on the magnitude. The neutral momentum is the normal profit because we cannot expect high momentum to alternate with low momentum. So that mean or that equilibrium line, the zero line in the oscillator, can be a first or a total profit taking, a partial or total profit taking from a divergence situation, because that is the level where I know for sure that prices, or for sure with a high probability, that price will turn into that historical mean. What I'm not sure or less sure, or with a less probability, is that high momentum will alternate immediately with a low momentum. Okay, I'm more sure that the price will reach an equilibrium and will stay in equilibrium than that it will oscillate between extremes in high and low momentum. Okay, so you can use the central line in a momentum as a target. So calibrate the target using the oscillator and not the price structure itself. Thunderfoot asks for I will explain the swing failure. Okay, fine. Okay, so we have seen the classic divergences, and very fast we'll cover the hidden divergences. Hidden divergences as practically the contrary concept. Hidden bearish, or it's a bearish trend following situation. A hidden bearish divergence is when the oscillator shows ascending highs while prices print lower highs. It is a bearish trend continuation situation. So here we have a different quality of a signal. It's a trend following a situation and not a trend change, so to say. Here we have an example of a hidden bearish divergence where we see prices in a downward trend, and we see here in the momentum oscillator, for instance, we see this ascending peaks. That means that retracement in the downtrend, that retracement has been done with more strength, with more velocity as well, with higher speed, and that means that it will probably encounter some supply in that case, because we are on a downtrend, and it shows a situation where you can set up a short position. You can help to spot for the best entry using simply an horizontal line here for support and resistance with the previous support, which has turned into resistance, and prices broke from there with quite a magnitude and velocity. So when prices go back into this level, it triggers that distribution action again, this supply evidence, the end price action, and then the ensuing trend continuation in that case. Okay, and then we have the hidden bullish, which is a bullish trend following situation. This is when the oscillator shows descending lows while the price structure shows ascending lows. And here we have an example with a rate of rate of change. In that case, we have this ascending price action, and here the lower values in the oscillator window. Okay, and this situation is obviously in hindsight nice to see that we have these nice periods, nice cyclical movements of 50 periods. So I calibrate the oscillator to the half of that cyclical movement. Okay, when we mentioned before that you should you should calibrate any cyclical movement that you detect in price. So the optimal calibration of parameterization of the momentum oscillator should be the half of that period, because you are detrending that price action. So if prices go up and down in a cycle, up and down another cycle, up and down, you want to detrend that action and have this situation here where prices go up and down within a cycle. You want to detrend that situation, to detrend that action, and see that action oscillating above and below an equilibrium level. And here you have this oscillating, this high and low, crossing an equilibrium level in the middle. Okay, so by using the half periods in the oscillator, you can detect these cyclical movements in price. Okay, this would be in a few words the best way to calibrate momentum indicators. Okay, and finally to swing failures. Swing failures is a common situation to be used with oscillators, but it is best used with the RSI. Okay, we shall see. Here we have this image in Spanish. I'm sorry for that, but the explanation is in English here on the side. This shows an idealized oscillator window, and we have when we have a peak in the oscillator which fails to surpass the previous peak, and it is followed by a break of that depression between both peaks. Okay, here we have a sell signal or a bearish swing failure. Okay, and on the bullish side, or on the oversold side, here we have two values where the second value is not surpassing the first one, and then the oscillator crossing that the intermediate peak is the signal. And different to the divergence, the swing failure is a signal in itself. Is a signal. Okay, by the way it is structured, it has a signal built in. So a swing failure does not require a divergence to occur. It may occur, but it does not require. That means the price structure can have the same form as the swing failure. Okay, the same M or W form can be seen in the price, and not necessarily you need a divergence. The swing failure signal is obviously stronger when it occurs beyond the overbought and oversold levels, although this is not a requirement for its classification. You can have a swing failure also short above and below the median line, the zero line, and it's equally valid. Okay, this is here we see an example, just to finish, with several swing failures detected using the RSI, with a combination of support and resistances, and you see how they could have been traded in a we have a downtrend where we see this nice plays with support breaking, become a resistance, breaking, becoming a resistance again, and this is allowing us to have a series of nice support on that nice resistance levels, pardon, to combine with the swing failures that we spotted here on the RSI. Okay, in that case, the RSI can be calibrated to a much shorter period, because we are only interested in what the price structure is doing in those peaks. So I may calibrate it to a much shorter period. For instance, I think this RSI is calibrated at 9 periods. So just to spot what is happening here in this in the last 9 candles around this extreme. Okay, I think that's all. We have covered some basic concepts around divergence analysis. We may come back to this topic again. We may also cover in-depth momentum analysis and review the concept of divergence once again. So I thank you all for coming, for your attention, and see you next time. Thank you. Bye bye.